Good Thursday afternoon, investors and traders. I'm just going to leave this here for a second. Take it in, take it in. Road unsafe when underwater. Talk about your no crap, no utility signals, right? I mean, this is a warning that need not be offered, right? Road unsafe when underwater. So welcome to this week's State of the Market. Forgive me if I'm a little out of sorts as it's back to school week for the kiddos and still trying to get into, my typical routine of picking up the kids. And then when they get home, they need this, that, and the other. So bear with me with this week's weekly State of the Market. But either way, I hope everybody's having a good week. Hope everybody's being safe. I know that we're still contending with the Delta variant, and hopefully that's hitting its apex here very shortly within the next couple of weeks. Although, and I know that a lot of Finom group members have received a lot of the data in and around the Delta rise. The one thing that I'd like to interject within context of some of that data that you've received is there may be the need to be flexible with some of the timelines around where some of the strategists believe that the Delta variant is going to peak or apex and roll over. And that could be the back to school season. That could throw a little bit of a monkey wrench into things. Those timelines may need to be extended. However, again, just kind of a caveat, something to consider as part of your flexible approach to that particular subject matter and how it may relate to economic data going out into the future as well as the equity market. All right, so road unsafe when underwater, no crap. That's not really a signal, is it? We've been speaking in terms of how this market is transitioning. We've been highlighting that for the last month. And something that I had mentioned, just yesterday here, strategy is not bound by or tethered to luck. Find a strategy that works for you. Incorporate your risk tolerance and breeds repeatable profits. Until you do, luck may be playing a bigger role than skill if finding a degree of success presently. We'll talk about your Freudian slip there. And again, this is thematic. A lot of folks in this new bull market are benefiting more from luck than actual skill. And as we transition from the early cycle bull market to the mid-cycle bull market, it's going to demand that much more skill, due diligence, game planning, just really getting focused, getting centered, and understanding why this is happening or that is happening in the market. Jason Swig of the Wall Street Journal kind of highlighted the same theme that we've been talking about in his most recent article from the Wall Street Journal, where ignorance is bliss, 'tis folly to be wise, wrote the British poet Thomas Gray. One of these days, perhaps sooner rather than later, stocks will stop going up. Kind of a no crap, statement as well. The importance of understanding what you own will reassert itself. For the time being, though, investors who used to think of themselves as wise may continue to look foolish, meaning that luck is kind of just, the whole Wall Street bets thing, the whole Reddit crowd thing. Like, some folks are doing very well with that. I mean, AMC, Bed Bath & Beyond, GameStop. Like these valuations, this price action in these names is just ridiculous. We haven't seen that before. But to Jason's point, to my point, these things don't last forever. They don't last forever. And those who are skillful right now that are kind of, having a tough time with this market that is rewarding the lucky more so than the skill, eventually the tide will turn once again. The skill, the discipline, The flexible, unbiased approach to the market will be rewarded over time. Unfortunately, I can't say the same thing for the lucky, the trend following, the momentum chasers. So do keep that in mind as we go forward. We've discussed recently just how strong and fast the buy the dip impulse has been throughout the post-pandemic bull market. An example of how strong dip buyers have been this year, the chart that you see there, the S&P 500 has gone 40 weeks without the low going under the 20-week moving average, the longest streak since back here in 1996. We had a really good streak as well here, 2009 into 2010. Of course, May 2010, we had a hiccup with the flash crash. So again, we've had dips. We've even had more than a 5% correction this year. I know we're on day 191 without a 5% correction, but that's on a closing basis. Why is Wall Street so enraptured with the closing basis as opposed to just the general move in the market? I couldn't tell you. I think it is misguided because we had a 5.8% correction from the end of March into the end of February into the first week of March, but we didn't close down 5% or greater. We had an intraday reversal rally that took us out of that territory. I think the market has been telling you, we have had a 5% correction. Stop it, people. It's just that it wasn't on a closing basis. Nonetheless, the streak is still alive, 191 trading days without a 5% correction on a closing basis. In terms of the streak that we're running without a dip below the 20-week moving average, only 5 streaks have been longer since 1950. The longest was 73 weeks. Right now we're at 40. We were at 60 weeks back here in 1996. The longest streak was 73. So we still have a ways to go if we're going to be record breakers, or even get to the previous streak of a little more than 60 back in 1996. What about breadth? Right? So we've been buying the dip, and we've been talking about breadth being poor, but it has started to climb. As of last week, we started to see improving breadth. So coming into this week, in the first 3 trading days of this week, indeed, breadth has continued to improve. S&P 500 on the top here, percent of S&P 400 above their 50-day moving average. You can see now almost 60%. S&P 600 is just above 50% of stocks trading above their 50-day moving average. And of course, the percent of S&P 500 above their 50-day moving average is now 67%, which is the best level it's been at since June. So breadth definitely improving across all cap levels, mid, small, and large cap S&P 500. So of course, sentiment is frothy and everybody's over leveraged and everybody's too bullish and euphoric. Well, it's not exactly what the NDR, Daily Trading Sentiment Composite Index, is telling us. Again, S&P 500 chart across the top there. And here's the NDR, Daily Trading Sentiment Composite. And we're just right here, folks. Let's see if I can enlarge it really quickly. Yeah, we're right above 50 right now, just above 50. We're essentially in neutral territory. And the stats around, if you're between 41.5 to 62.5, you're in neutral territory. The percentage gain per annum for the S&P 500 when you're in neutral territory is 9%. What's the problem here? We're not as euphoric as the relentless rally in the S&P 500 would have you assume. Secondly, the AAII survey, I can go to it really quickly actually so you can see it. This comes out every Thursday if you're not familiar. It's a retail sentiment survey. And you can see the bullish sentiment here in green, neutral is gray. Crap, I forgot the color here. Yellow, for bearish sentiment. I'm colorblind for those of you who are new, but it's close to yellow. You can see it's been rising bullish sentiment, but the key here is it's at 37%. The historical average is 38%. We're not even as bullish as the historical average. Again, just another measure telling you, no, we are not overly euphoric, not overly bullish, no matter really what survey you're looking at. All right, so one of the reasons why, I put this sign here today is thematic. Road unsafe when underwater. Again, is that really a signal? Or is that necessary? For most people, they look at it, again, that is just noise. And we get a lot of noise in the market, especially when we haven't had a bigger correction, especially when we've traveled 100% off of the March 2020 low. Recall just about a month ago in early July. In fact, it was in our State of the Market on July 2nd. The notes here from Stifel Nicholas's chief equity strategist, Barry Bannister. And they basically were calling for an 11% correction and Bitcoin to drop to 12,000. Bitcoin 12,000, 11% pullback on the S&P 500. And they gave you their rationale centered on the US ISM PMI numbers, manufacturing. They wanted you to buy cyclicals relative to defensive areas of the market, buy pharma, biotech, staples retailing like Costco and Walmart and maybe even Kroger and Target, commercial and professional services, utilities, healthcare, household products, consumer services, and telecom. It's a lot of stuff that you could have bought for an 11% pullback. In some sense, that didn't make sense in and of itself, right? I mean, this is a broad part of the market here, but you're looking for an 11% pullback. Notice there's no mention of technology in their notes of what to buy. And I guess that you could, in that manner, understand that, well, yeah, FanMag, tech, Microsoft, Apple, semiconductors. I mean, if they're not working, yeah, the market could still pull back, and even if other areas of the market, very broad areas of the market are rising. So I get that. Nonetheless, excuses, in my opinion, just excuses with the ISM. They've been making this call since April of this year. Stifel's Barry Bannister, 10%. So we've talked about all this before. Was this a signal? Right? This was their warning. That still hasn't come to fruition. Just last week, Lizanne Saunders with the Bank of America Merrill Lynch bull bear indicator reaching its highest level in some time here. This is basically their sell indicator, right? Their sell signal, if you will. But we also rationalize this against, this was their same sell signal back in February. The market's still traveling higher ever since. Calls for a big pullback, calls to sell stocks in perpetuity. They're not really signals. These are people, these are institutions that just, they're looking at the probabilities of pullbacks. And if they don't happen, it just keeps registering and cycling. And so they just continue to pump these out. And, even before that, Morgan Stanley's on June 10th, so going back 2 months now, Morgan Stanley, their combined market timing indicator, which has been in sell territory since March, just hit a new all-time high of 1.19. Like we've discussed this in past weekly State of the Markets. And there you go, 3 different institutions, 3 different sell signals. You want to throw Michael Santelli from CNBC and the mystery broker in the mix here? That's another one, right? Calling for a pullback. Canaccord Genuity, Tony Dwyer calling for a pullback. These are just ongoing. And recall that a lot of these pullback calls have also referenced weak breath in the market, right? They were referencing weak breath. Therefore, we should get a bigger pullback. Well, we didn't. And by the way, Stiefel, Barry Bannister, just this week, once again, 10% correction. He re-upped his call yet again here this week. So if you didn't get a market correction with weak breath, and we actually have breath strengthening now with advanced decline lines in the S&P 500 hitting an all-time high yesterday with the S&P hitting an all-time high. Even small caps have been working. The small cap advanced decline line broke out above its 50-day moving average yesterday. What are we doing here with these signals, folks? You didn't get it with weak breath. Breath is strengthening, but you're still calling for the same correction that you were calling for when we had weak breath. Is breath even a signal? Now, when breath is weak, it's more of a signal because it's actionable. When it's strengthening, usually the market is trending higher. It's hard to buy as, price is going higher. It's easier to buy when price is going down and you have a game plan to buy those pullbacks. But again, the logic here. Breath is weak. You're probably going to get a correction. Well, breath is strengthening now. We're probably going to get a correction. I don't know why the institutions get paid, but they get paid. Anyways, and here's another. This one comes from Jesse Felder. Again, looking at breath in the market by way of Hindenburg omens. If you're not familiar with what a Hindenburg omen is, by themselves, they're not a very good signal. But when they cluster, as they did here, they did here, they did here, they did here, here, and they're clustering again, they tend to deliver a better signal. Hindenburg omen, this is for the NASDAQ, and we've had a cluster of 10 Hindenburg omens here in 2021. So Jesse Felder, some of you are familiar with Jesse Felder. He's kind of an alarmist in and of himself. I wouldn't call him a perma bear. I don't think he's very much into the equity market, trading and investing, but he makes a pretty good name for himself writing about equity markets, which is another point I want to emphasize. Most of the financial media participants, most of the big names in social media with their blogs and newsletters, they don't make their money investing. They don't make their money trading. They make their money talking about investing and talking about trading. You have a different agenda than they do. They don't have skin in the game by and large. You do. The impulse is different between yourself as an investor and what they call market watchers, like Jesse Felder. So in his latest article, which you can click the link here and read it, it's good information, but you need to be able to decipher, the efficacy of this signal. As has been, that's Twitter. It is Twitter. All right, folks. Live recording during the course of the trading day. Did I think that we were going to get our profit here? I indeed did. I've already got the trade alert ready to go. So we bought Twitter here on the dip this morning, and we just hit our profit objective. We're selling it now. All right, back to Jesse Felder. Sorry for the interruption. Nice job, team, by the way. As has been widely reported, stock market breadth has been showing signs of deterioration again recently. Specifically, a total of 10 Hindenburg omens have triggered on the NASDAQ over the past 6 months, a level that has regularly warned of significant stock market turbulence ahead. I said that word rather well. I'm not good with regular, you see what I mean. While an individual signal has very little value in forecasting a stock market crash, a cluster of signals can be valuable in that it signals a pattern of dispersion that is not compatible with a healthy uptrend. In other words, where there's fire, there's smoke. A warning signal. The following 6 weeks of stock market action prove the value of this sort of signal yet again. And he's speaking to this time frame in going into the pandemic. Hindenburg omens don't cause anything. They can simply catalyze. You still need a catalyst. This can create the momentum. It's as Jesse says, it's a warning signal. But what you need to know as an investor are, what are the qualifiers? How do we know if it's an effective signal or if it's just noise in the market? Even clusters in the past don't necessarily work. Look at this, up, 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 up. In 2017, we had a ton of them. Just went higher through the end of the year. Here's 2014, up, 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 up. So it's not a perfect signal. You need to know what the qualifiers are so as to be able to know how much efficacy there might be in this particular cluster of signals. All right, and I've noted them all right here by bullet point. This is the one that I'm highlighting. McClellan oscillator, a measure of the shift in market sentiment, is negative, meaning it has to be negative. If the McClellan oscillator for the index is negative, then you have a qualified cluster of signals. On top of all these, the daily number of new 52-week highs and new 52-week lows in the stock market index are greater than a threshold amount, typically 2.2%. I'm highlighting this one, has to be negative. The McClellan oscillator for the NASDAQ, because this is the NASDAQ that we're looking at so far as the Hindenburg omens, has to be negative. If it's not negative, the signal is not valid. Here we are, folks. 9.02. We came out of negative territory just a few days ago, maybe last Friday, and we're at 9 right now. We were in negative territory. That's probably why we've had so many Hindenburg omens here this year. We've spent a lot of time in the under zero in negative territory for the NASDAQ McClellan oscillator. So I get it. You're going to have a lot of clusters, but we are out of negative territory, folks. The sentiment has shifted positively, not negatively. Unfortunately, you won't find this in Jesse Felder's article and warning signal. This is the additional details. This is the additional research that you have to do. The average person may be out there reading his articles in social media, retweeting it, liking it, probably not going to do this kind of work for you. We're going to get it done. All right. So another warning, we now have 4 or 5 that we've gone over, and trust me, there's more. But with every, not with every bad, because there's so much bad out there, we do want to throw in some good. And the good signal, if you will, comes from the DeMark count. And here's Mark Newton talking about it just yesterday. S&P 500, not saying, he missed the T, not saying S&P 500 needs to turn down right away, given the presence of DeMark, combo, and now sequential sells. These haven't been confirmed yet. And setup count might complete at near before a stalling out at possibly 44.67, particularly as weekly counts not complete. But as of Wednesday, as of yesterday, the count, 13 cell setup for the DeMark count, and it's happened 5 times now this year, 1, 2, 3, 4 times previously. Yesterday completed the 5th time and basically points to higher levels going out the next 3 months. Chart here is from Tom Lee of Fundstrat, and this is what he says. Tom Lee of Fundstrat says DeMark recycled sends further risk-on signal. Prior to last week, 4 13 counts have appeared. which is the chart here. Usually, you start to sell off after the 13 count. But only one led to a sell-off approaching 5%. That was this one here, 5%. The 13 sell setup appeared on Thursday, 8/5 last week. And per the mechanics of the DeMark indicators, a reaction sell-off needs to happen within 4 periods. So if we go back to Thursday, you had Friday, Monday, Tuesday, Wednesday. If the market doesn't sell off on that 4 days after the 13 DeMark sell setup, you basically have a risk on for equities going out over the next 3 months. If no selling on day 4, we get a recycled 13-day count or 13 sell setup count. This is akin to what happened on April 8th. That was this one here. Remember, folks, April, breadth was really strong and strengthening. On April 14th, we had the percent of stocks trading above the 50-day moving average above 90. It's hard to get that, selling action when breadth is improving that greatly. So essentially, we now have a DeMark that's recycled because we didn't get the selling that has to happen by day 4. We didn't get it. So it's now a recycled count. And when that happens, this is akin to what happened on April 8th. Equity since gained another 8% over the next 3 months. And that's the typical average, folks. So, Tom Lee is now that much more risk on. He's recommending FANG and epicenter stocks, oil, small caps, casinos, travel and leisure. Those are the kind of names that he's been recommending. All right, this chart. So we do have somebody that's very bullish. He's not issuing a warning, but rather, maybe a warning that it's going to be risk on, based on the recycled DeMark count that just fired as of yesterday. This chart right here, one of the things that we've been highlighting is we know that rates are going to go back up. How much higher is anybody's guess, but we know that we've probably hit a interim low in the 10-year yield. We bounced off that low. I've been of the opinion we're going to at least get back to 150 on the 10-year yield, and that's going to play, with the whole rotations again, right? Typically, as rates are rising, we tend to see some underperformance in growth, NASDAQ, as well as FANMAG, if you will. And we tend to see some outperformance from value, cyclicals, those areas, financials, energy, those areas of the market. So this latest chart from Frank Capillari, a very, very renowned technician, points to how the 10-year yield has basically been dictating these rotations, over the last probably year. You have the Russell 2000 versus the NASDAQ in the dark shaded line, and you have the 10-year yield in the lighter shaded line here. And so what he explains is that over the past 14 months, the ratio of the Russell 2000 versus the NASDAQ 100 has basically been dictated by the movement in the 10-year yield. We've discussed that at length here at Finom Group. Frank explains that the 10-year yield has been driving a lot of the rotation in the stock market since the March 2020 low. The 10-year yield took a breather recently after a 5-day winning streak, and it's currently sitting in a pretty interesting spot between the 50 and 200-day moving average. This recent rebound in yields has benefited cyclicals, and it has. We've seen small caps rally a bit. We've seen the financial sector ETF hit an all-time high. The regional bank sector ETF has been rallying. Energy has been rallying. The BETS, the casino, BETZ is the casino ETF that rallied. So the epicenter stocks, the reflation trade has come alive again. The one thing that we've discussed in the Finom Group trading room, however, recently is I'm not of the opinion that the magnitude of underperformance and outperformance when we look at value versus growth or value versus tech growth, NASDAQ, the magnitude of that relationship will not mirror the relationship that it had basically from September of last year, where the epicenter of the reflation trade started, to about May of this year, when finally tech, NASDAQ growth came alive again and took leadership back. I think that investors have seen that regardless of the rise in rates, it had no impact on tech stocks. They delivered exceptional earnings and revenue growth. So I think investors learn that the 10-year yield is just giving off a lot of noise, and it's not a signal. I don't think it ever was a signal. I think it was more a matter of tech growth, NASDAQ. It's pretty much what led us out of the recession or the bear market. It had already priced in the recovery, which is unusual. Tech doesn't usually lead. The NASDAQ doesn't usually lead out of a bear market. It usually is equal weight S&P 500, small caps, financials, banks. That's what typically leads. So this was a divergence from the historical occurrence of what holds leadership coming out of a bear market. That being the case, and having seen that the 10-year yield, the rise in yields didn't affect tech, NASDAQ, and growth, FanMag, during the second quarter based on what was already released in earnings, I don't think investors, regardless of what rates do, are going to significantly rotate out of tech. If anything, I think they're just going to increase their leverage to epicenter stocks, cyclicals, the reflation trade. And here is a look at, because another way that we can look at, Frank Capillary's chart here is by looking at the value versus the growth relative performance ratio. So again, from September to this peak here in March, value outperformed growth. But growth came back and value has been underperforming since mid-March and has started to lift again. And that's why I said we've gotten better breath. So, this is a large part of the market. Value, financials, energy, cyclicals, big part of the market. It comes with better breath. But I don't think we're going to see this kind of level here. I'm not so sure we're even going to see this level here for all of the reasons that I mentioned. The one thing I also want to point out is through this whole cycle, and keep in mind that value is still underperforming year to date. It's still underperforming growth year to date. Imagine if you had tried, to constantly chase the rotations in the market. One of the things that I'm often found saying is investors can make investing as complicated or as simple as they want to. You would have made things very complicated for yourself if you had been trying to chase the rotations and leaned into the value trade. Do you think that you would have sold here your value, your cyclical stocks, right? And then it did rebound, right? So if you didn't sell here, you had that much more confidence when it was trying to make, another blow off top here, but then it didn't. And it got back down here. Again, you probably said to yourself, it'll come back, it'll go up again, but it didn't. All it did was go lower and lower and lower. What was the easiest participation in the whole value versus growth dynamic this year? In my opinion, the easiest participation was just to buy the weakness in growth. You know what's going to happen there long term. Growth is going to outperform over time. And think about the value you got if you did buy the dip, in FanMag, in growth, in the NASDAQ. Tremendous value. And again, That was the easiest trade to make. This one demanded a lot of conviction and discipline. Indeed, you should have sold here before it dropped all the way back down. But what is your psychology there? That is a difficult trade to make, especially when it's done so well. It's lulled you to sleep as a value investor. Don't chase the rotations. Know that they're happening. Know that they're happening and feel that breath. Keep that touch point with the market. But when tech gets weak, it's your opportunity. So keep it simple. Just keep it simple. We can make investing as difficult or as simplistic as we want. The long-term trend suggests buying tech NASDAQ growth weakness over trying to time the market's rotations and the duration of the value cyclical strength. So, I mean, you can't judge it. You don't know when it's going to fall apart, that value cyclical trade. You know the tech NASDAQ growth trade isn't likely to fall apart. It's a concentrated trade, but it's one that's pretty strong nonetheless and has a long history of outperformance. Here we go again, folks. All right, so we had the good, we had a good signal from FundStrat looking at the DeMark counts, and it's recycled and what the forward probabilities are for the market. We've got another alarmist here, liquidity alarm, the Marshallen, and this was highlighted in a recent Bloomberg article. This comes to us from Lighthold Group. Lighthold Group Chief Investment Officer Doug Ramsey warned clients last week that the Marshallen K indicator falling below zero could presage a market correction. Keep in mind, going all the way, because Doug Ramsey works with, he's often on, James Paulson. So Doug Ramsey and James Paulson of the Lighthold Group. And James Paulson's been calling for upwards of a 15% correction since probably April. Remember what I said about, they're going to give you their excuses. Another excuse, folks, right? I've been calling for a correction for so long. Let's just attach some rationale to it, right? And there's history. I mean, it's not like this is just fabrication. There's history. You see the highlighted areas here, when the liquidity falls below, falls below zero. Marshallen K is essentially a measure of liquidity, the difference between the rate of growth of M2 money supply and the rate of growth of the economy. Put another way, the recovering economy is now drinking from a punch bowl that stock markets once had all to itself. That's Doug Ramsey of the Lighthold Group. How big a threat is this? While stocks kept rising during frequent negative Marshallen K readings in the 1990s, the pattern since the 2008 global financial crisis, a period when the central bank was in what Ramsey calls a perpetual crisis mode, begs of caution. The sample size of this, and that's the thing, folks. What are we talking about here? 1, 2. That's it. That's our sample size. Until now. 3. Like, really? I mean, it worked. I mean, these are the two effective signals. I mean, it was firing all back here. You could say 5 signals, 3 that never, resulted in anything, and 2 that did. And, Doug Ramsey suggests that these signals are coming in, basically in an era since the great financial crisis where maybe the signal is stronger because you've had that much Fed intervention or Fed liquidity provisions. Maybe it's that much. And maybe he's right. In my opinion, look, if we have a bigger correction here in the not too distant future, coincidence. Remember, no one signal causes anything. It's usually a combination of factors that result in a bigger market drawdown. Oh boy, real investment advice, or RIA as they're known. And some of you might be familiar with the personalities from real investment advice. This chart here, again, talking sell signals, we're talking warnings, deviation above the 200-day moving average. Lance Roberts, he's a well-known perma bear from real investment advice, works with Michael Leibowitz. He's also another perma bear. Constantly, no matter what the market conditions are, article after article after article of just bearish thesis, warnings after warnings after warnings. They've been doing this for 12 years. 12 years. RIA Advisors. This is their team. Lance Roberts right there. Michael Leibowitz right there. These guys are fantastic. I mean, if you want to scare yourself, go read their works. And they'll put out a piece almost every day or every couple of days. These guys, they'll get it done if you're looking for fear. They'll get it done. But this particular article discusses deviation above the 200-day moving average. When prices deviate too far from the moving average, eventually prices will revert to or beyond the average. Reversions to the mean is the iron rule of financial markets, says John Bogle. We can visualize the reversion in the chart above. As you can see, here's the S&P 500, deviation above the 200-day moving average or below the 200-day moving average. This chart right here tells you where we are today with respect to the S&P 500 above the 200-day moving average, or deviation above the 200-day moving average. Like, we haven't touched it in a while. We're 11% above the 200-day moving average right now. Looking back historically, whenever deviations exceed 10%, we're 11% right now. Looking back historically, whenever deviations exceed 10% above the 200-day moving average, a correction generally ensues. That's from Lance Roberts. That's what he wrote. Is that true? The answer is no. The answer is no. Not always. I mean, we can be well above it. In fact, the NASDAQ is generally between 15 and 20% above its 200-day moving average. But we're talking about the Lance Roberts talking about the S&P 500. So in saying no, this is not necessarily true. He's fabricating this information. Can we get a corrective or consolidation in the S&P, being double-digit percentage above the 200-day move? Yes. It has little to do with mean reversion, though. You still need some type of catalyst. And oh yeah, we can talk about catalysts till you're blue in the face. But this shows recent history going all the way back to May of last year. 16% above the 200-day moving average. 16%, 16%, 16.2%, 16.8%. 16% back in April. And we're still 11% above the 200-day moving average right now. Well, how does that happen? Because, I mean, and we did get nice corrections after, here we are up 16%, some consolidation here. 16%, very minimal consolidation. I mean, we just had hiccups since. So, I mean, clearly, Lance Roberts is just fabricating stuff. He's good at it too. I mean, they have their own charts, they have their own software. They can literally write and code whatever they want and have frequently. All right, so since 2020, turns out tech drove the correction move each time, but only when it was trading 36 to 40% above its 200-day moving average. Tech had to be trading 36 to 40% above its 200-day moving average. That's what drove the S&P 500's correction. It wasn't just because the S&P 500 itself was 10+% above its 200-day moving average. You had to have the tech index 36 to 40% above its 200-day moving average. Structure of the market, folks. As shown in the chart above, the S&P 500 has been more than 16% above its 200-day miss several times consistently. But what about tech? All right, so what is the composition? There is actually the tech index, which is the NYSE FANG plus index. All right, and you can find that via stockcharts.com. Just type it in. Just type it in here, NYSE FANG, or NY FANG, I should say. I've done that already, obviously. NY FANG, and the chart will pop up. As you can see here, look how far above, here's FANG, if you will, or the tech index, and look at the distance to the 200-day moving average. Almost 40% above. You get a corrective wave in FANG, or the tech index. You are going to get a correction at the index, the S&P 500 as well. Why? Because those are the most heavily weighted in stocks within the S&P 500. Your Facebook, your Apple, your Amazon, your Netflix, your Nvidias, your Googles. But ever since then, we're only 10% above the 200-day moving average right now in the tech index. That's it. Because look how much, like even when we had this corrective wave here in NY FANG, the 200-day moving average just keeps going higher. Like we just got back to a new high here in mid-June, but all the while, the 200-day moving average is rolling higher. So time caught up with the index, and now it's only 10% above. The tech index is only 10% above the 200-day moving average. It's not overbought based on its history. Look at the white here. Look at the white, folks. It's not overbought. People keep saying the market's overbought, the market. You can believe that till you're blue in the face, but you better know the structure of the market and why it's been so hard to get a bigger correction. Because technically speaking, the tech index is not over. It's not even close to overbought because time has caught up with it through this corrective period here. Remember, the S&P 500 is cap weighted, and it's top heavy with tech FANG names. FANG is not overbought based on this analysis, which also rationalizes why it has proven difficult to execute a larger correction in the S&P 500. Structure matters. You can look at a chart till you're blue in the face. If you don't understand the structural components of what you're doing technical analysis on, how can you weigh its efficacy? A chart that only tells you so much. You need to go above and beyond that and understand the composition of what you're charting. People talk about valuations. This goes hand in hand with tech, with FanMag, if you will, right? Because everybody's just up in arms. Look at the CAPE ratio. Blah, blah, shut up. Even though valuations are cheaper today than they were at the beginning of the year. Remember, we came into this year. The S&P forward price to earnings ratio was 23. We're at 21.3 today. The market is cheaper today than when we came in at the beginning of the year because the earnings have just been accelerating faster than the S&P 500 has been. The top shows you, this is the S&P 500. That's the price to earning multiple. But what if we strip out FanMag? We take out FanMag, the S&P 500 multiple is just 18.7. Know the structure of the market. Should the market be, if you think about what was just reported by FanMag, should the market multiple be higher or lower than where it is today? There's nothing wrong with what FanMag reported. They all beat. They all handily handily. Market is not that expensive. It's not the S&P 500's fault that FAMAG produces, outsized earning growth above and beyond consensus analyst estimates. And they're going to do the same thing in the third quarter, more than likely, based on what we're seeing in the economic data. Again, these people, they're all up in arms about the CAPE ratio, right? The price to earnings ratio for the S&P 500 is at the highest level that it's been since the dot-com bubble. And of course, you want to throw these warning signs out there, just look at the trailing CAPE ratio here and look how high it is. But to my point, know your market structure. I asked the question just a second ago. Should the S&P 500 today be at this PE ratio with rates this low? Forget about structure if you want, but what about rates also? And here's the other thing, valuation. Again, this is what the perma-bear community and those who just want to scare investors like to do. They talk about valuation. We know here at Finom Group that valuation has no correlation to S&P 500 one-year returns. None. What this chart also shows you, and it's funny, people will do technical analysis on any chart, on any market-related chart. For whatever reason, though, they don't want to do it on a valuation chart. Because the valuation chart will tell you PE multiples go higher over time. That's what this shows you. The trend line is moving higher over time. And it's moving high. You have higher lows, and eventually we're going to have a higher high. You may not like to hear that, but we are going to eclipse at some point in the future. We are going to eclipse the valuations that we saw in 99, 2000. It's just a matter of when, because history tells us that valuations travel higher over time. All right, we have not had a 5% correction. I know, on a closing basis. We have not had one trading day below the 200-day moving average. Not one trading day below the 200-day moving average. This table here from Bank of America Merrill Lynch, solid returns for the year when the S&P 500 does not have a daily close below its 200-day moving average through June, which is the case this year. We have not had a close below the 200-day moving average through June of this year, let alone to date. But this does not tell the entire story. So it's happened a lot. Presidential year, first half year returns, Q3 returns. It tells you if you have not spent, one trading day below the 200-day moving average, the Q3 return, 1.27%. The percent positive time in Q3, which is the time period we're now, 64% of the time the market is higher. Q4, a bigger return, almost 4% average return, 85% of the time the market is higher. Annual return is about 17%. Well, that's what we've done already. But the market is up 88% of the time. Again, this is if you have not traded below on a closing basis, the 200-day moving average through June. Stats look good. This next table from Bank of America, S&P 500 performance went above the 200-day moving average through June, but moves below on a daily closing basis prior to year end. This could come into play, right? If we get one closing below the 200-day moving average this year, then we'll need to understand the probabilities for Q3 and Q4. And you can see percent of time up in Q3, not good. Average return is negative. Q4, average return is positive. It was probably a buying opportunity. Think about it. You've gone basically the entire first 6 months of the year without a close below the 200-day moving average. Okay, so fine. Finally, you get a bigger correction. you close below the 200-day moving average, things must be going good that year in the first 6 months. So more than likely, this was just a consolidation. Maybe there was a catalyst, but it still wasn't enough to shake investor sentiment regarding the outlook for earnings and the economy, so they bought the dip. Up 3% in the fourth quarter, up 76% of the time. Again, annual returns are positive and double digits. I guess the only question that remains really is, as we go into September next month, what could the catalyst be? I think we all know what it is, right? The elephant in the room is Jackson Hole and beyond, right? The Fed. That's the elephant in the room. What could catalyze a bigger correction and a test, if not a close below the 200-day moving average? It's probably going to be something that's centered on when the Federal Reserve messages its tapering plans. I'm not of the opinion they're going to do it at Jackson Hole. There's a contingency of market watchers, of strategists, of analysts that believe that they'll message in September, which just so happens to be, one of the worst months, if not the worst month of the year for the S&P 500 going back to 1950. My thoughts on them possibly messaging in September are the extended eviction moratorium ends in September. The unemployment insurance benefits from the rescue plan end nationally in September. Does the Fed really want to go down that road in September too? Just kind of, adding fuel to a fire that don't know what the ramifications of those programs are ending are going to be like. I mean, there's going to be some kind of, reaction in the economy amongst households when the eviction moratorium ends and the unemployment insurance benefits also end. Does the Fed really want to add fuel to that fire, not knowing initially what, the reaction is going to be from those two benefits or programs ending? I think that lacks strategy. I think the better opportunity for them to message would be after they have an understanding of the reaction, how many people were going back to work. Also, they'll have more, data when it comes to have we not apexed the Delta variant. So September still seems like not the way to go. October may be better. And there's a contingency of market watchers and strategists that believe they're not going to message until November. You don't need to know when. Bottom line is you don't need to know when. You just need to know it's inevitable and have a game plan. Have a game plan. The savvy investor will look at a bigger correction as an opportunity. That's where you need to get your mindset. The only way you're going to recognize the opportunity when price weakens is to have the game plan. What are you going to buy? Does it line up with your outlook for economic growth 3 months out, 4 months out, 6 months out into 2022? If it does, execute, because this is likely opportunity. Most market watchers, they're hearing this constant drumbeat of the biggest risk to the market right now is the Fed. I mean, you put those two words together, absolutely, big and risk. It's an easy way to intimidate the average investor. The savvy investor uses any pullback as an opportunity. They see opportunity where others see big risk. With that being said, thank you for joining me here, State of the Market. To get our video every Thursday evening, subscribe to phenomgroup.com. We'll see you next week.